Last week, the Bank of Japan shocked markets by announcing big changes to its decade-long flood of cheap money. Will Japan now join China in pulling trillions out of the U.S., taking out the cheap money propping up our ruling clowns? So what happened? The Bank of Japan announced they're winding down their decade-long yield curve control, a system of manipulating interest rates so money is cheap to borrow without hurting pensions and banks. That policy has already driven trillions offshore seeking higher returns, especially to U.S. and European stock markets and bond markets, but above all to U.S. treasuries. And now those trillions could be going back to Japan. So what is yield curve control? Bond yields are the interest rate you get for holding a bond. A 2% rate means you get $2 per year on a $100 bond. I mentioned the yield curve in a recent video, but it measures the interest rates for different lengths, so 1 year, 5 year, 10 year. What Japan wanted was essentially zero rates on the 1 years and 5 years to artificially stimulate its economy, with only slightly higher rates on the 10 years, since Japanese pensions would go bankrupt if their long bonds were earning negative rates. To keep rates low, the Bank of Japan promised to buy as many 10 years as it takes. Remember, by buying bonds, it raises the price, which means a lower rate of return. To illustrate, if a $100 bond is paying 2%, so $2 in interest, and the price goes to $200, now that is a 1% bond. Fantastic, of course, if you're a banker who owned the original $100 bonds, which are now worth $200. The problem is this meant massive injections of fresh money into the economy, to the point the Bank of Japan now owns a majority of Japanese government debt, over $4 trillion. In fact, the Bank of Japan is now the largest owner of stocks in Japan, owning 80% of new exchange-traded funds, ETFs, and owning over 7% of all the publicly held corporations on the Tokyo Stock Exchange. This is not sustainable. At some point, the Bank of Japan owns everything in Japan. Even the Soviet Union did not own literally everything. So the bank knew it could not go on forever. In fact, they had already pulled back a couple times, bumping the 10-year ceiling in 2018 and then 2021. But now they ripped off the Band-Aid, saying they'll abandon targets altogether. They did promise flexibility to try and calm markets, but the move still sent Japanese stocks and the yen in gyrations. For Americans, the main impact is that Japan's low rates have so far sent about $3 trillion offshore, overwhelmingly to the US and Europe, chasing higher returns. If zero policy is now history, that money will start to go home, meaning they will sell U.S. treasuries, U.S. stocks, European bonds and equities, everything from Brazilian sovereign debt to European power stations to high-risk loans. This could further drive down, especially the U.S. dollar, which has already fallen almost 15% since September. Now that Chinese are pulling money home to shore up their slowing economy, if Japanese money too is going home, that takes out $2 trillion stacks that have been floating the US and European economies and the currencies. The free pass may be coming to an end. Okay, we'll be watching. See you next time.